Hello there, world. Welcome back to my channel. If you're new here, I'm Joe, a licensed certified public accountant with over 10 years' experience in corporate and public accounting. I have an extensive background in accounting, audits, and taxes, and I'm all about helping you take control of your money and live smarter. If you receive Social Security benefits, you might be wondering, do I have to pay taxes on this money? How much will I actually keep? What can I do to prepare? Good news. Today, we're breaking it all down in a simple, no jargon language. You don't need to be a tax expert to understand this. Let's talk about how Social Security is taxed, who it affects, and how to keep more of your money. Be sure to subscribe to our YouTube channel for more videos. And be sure to check out our website where we post every Monday, Wednesday, and Friday. Let's start with the big question. Is Social Security income taxable? So, here's the answer. Sometimes. Not everyone pays taxes on it. Whether you pay taxes depends on two things: how much other income you have and your following status. If Social Security is your only income, chances are you won't owe taxes on it. But if you have other income like a pension, part time work, savings withdrawals, or a spouse who works, some of your Social Security could be taxed. The IRS uses something called combined income to figure out if your Social Security is taxable. Don't worry, here's the simple version. So, what is the combined income formula that the IRS uses? They're going to look at things like your regular income, like a job or a pension. They're going to look at any tax free plus any tax free interest, like from a savings account or anywhere else you would get your interest. And then they're going to take half of your Social Security income. And then once you add that up, and they're going to compare it to these other thresholds. So, what are the thresholds? Let's look at some of the following statuses that are going to determine how much of that Social Security is going to be taxed. So, this first one is going to be for those that are filing single. So, if you're single, and remember the key word here is your combined income from the previous slide. That formula is what we're using to determine these numbers that are up on the next two slides. So, if your combined income is under $25,000, then your Social Security income will not be taxed. If your combined income is between 25,000 and 34,000, up to 50% may be taxed on your Social Security income. And if you have a combined income of over $34,000, up to 85% may be taxed. Now let's take a look at those that are married filing jointly. So if you're married filing jointly, the threshold is if your combined income is below $32,000. Your Social Security income is not going to be taxed. If your combined income is between 32,000 and 44,000, up to 50% may be taxed. And anything for your combined income, if you're married filing joint, over 44,000, up to 85% may be taxed. It's important because this doesn't mean 85% of your Social Security goes to the IRS. It means 85% of it gets added to your income for tax purposes. You still keep most of it. So remember that. What we're saying it could be up to tax is actually means that 85% of it can be added to your income for tax purposes. All right, let's take a look at a real life example of a single taxpayer who has Social Security income. All right. So in our real life example, uh, we'll say our person we'll call we'll call them let's call them Barney Rebel. So we'll say Barney Rebel who's single and receives Social Security income and has a part time job. So his Social Security income is $18,000 just in Social Security, and then he has a part time job where he earns $10,000 a year from that part time work. Here's how you combine the income. The income is going to be the combined income that we're looking at is 19,000. And I know you're probably wondering, hold on, Joe. 18 plus 10 equals 28. How the heck did you get 19,000? It's because what we're going to do is we're going to take the other income at $10,000 from our part-time work for Barney, and then we're going to take our Social Security income at 18,000 and cut it in half. So that's going to give us that $9,000. So it's going to be 10,000 plus 9,000, which gives us our combined income of 19,000, not 28,000. That's going to be not taxed. And since this is under our threshold of 25,000, Barney won't owe any taxes on his Social Security. But if his part-time wages was higher than 20,000, his combined income base would become 20,000. If he had 20,000, let's say from the part-time work, plus 9,000 from the Social Security that we're taking half of is 29,000. Now he's in the range where up to 50% of his Social Security may be taxable. You can't avoid paying taxes, but you can plan ahead and be smart about it. So, how are we going to plan ahead? Number one, we're going to know your combined income. Remember to use the formula. It's going to be your other income, which is going to be from another job, part time work, or your pension or retirement income, plus any tax free interest that you may receive, plus half of your Social Security income. Number two, we're going to watch our withdrawals. Remember, you're pulling money from your retirement accounts like 401ks or IRAs adds to your income, which can make more of your Social Security taxable. Number three, consider a Roth account. Roth IRAs withdrawals don't count towards combined income. This can help you to lower your tax bill later in life. Number four, it may be worth hiring a pro or talking to a pro if you need one. You might want to talk to a tax professional, can help you to look at the big picture, especially if you're retired and have multiple sources of income. Highly recommend talking to a CPA or a tax accountant or maybe even a tax lawyer. You can choose to have taxes withheld from your Social Security just like a paycheck. This is advice that I often give to my retired clients who are on Social Security and may have some other sources of income. Usually at the end of the year, there's usually some sort of surprise that they either owe or the refund's not as much as they thought it would be. But usually it's because they owe. And I just simply tell them, hey, go back and voluntarily tell the Social Security office that you want to have taxes withheld from your Social Security income. This will reduce the surprise at the end of the year and it'll help also offset so that you're saving more of your money. The IRS offers options. You can have 7%, 10%, 12%, or 22% withheld from your Social Security income. You just have to fill out a simple form called a W-4V and send it to your nearest Social Security Administration office. This can help you to avoid a surprise tax bill at the end of the year. And again, that form is a W-4V. Let's quickly recap what we went over today in this video. Remember, not everyone pays taxes on Social Security. It's really dependent on your combined income. Up to 85% may be taxed, but not 85% of your check. You can plan ahead to reduce the tax bite. Withholding taxes from your Social Security check is an option. So, what's your bottom line if you receive Social Security income? Remember, Social Security can be partially taxable depending on your total income. The key is knowing the rules and planning ahead so you don't get a surprise at tax time. If this video helped you, give this video a thumbs up and subscribe for more simple money tips. And tell me in the comments, did you know part of Social Security could be taxable? And join me next week to talk about how long should you keep your tax records. Don't forget to subscribe to our YouTube channel for more videos. And check out our blog site where we post every Monday, Wednesday, and Friday.